This may sound weird, but the difference between somebody who is struggling to make ends meet and somebody who is making a ton of money in the stock market is surprisingly small. You may have recently been thinking about investing in the stock market, but you are unsure how to go about it. Isn't there just too much risk? In this video, I will tell you everything you need to know about investing, how to open up your first Brokerage account, and make your first purchases towards an investment portfolio. The video is divided into hopefully useful chapters so that you can bookmark it and come back to it when you want specific answers. You may have heard that inflation has been soaring in year 2022, where it used to be about 8% on average. This practically means that the price of everyday products rose about 8% for that year alone. If that happens for multiple years, it doesn't take too long for the price of bread to effectively double. These small price increases compound through the years, and you need to find an effective way to make up for that loss and even make some extra money on the side. Remember this golden rule about money? A dollar today is always worth more than the same dollar tomorrow because money loses value over time. We need to find a way to work around that. And the way to do that is to use compound interest to our advantage. So how does that work? I want to give you a simple example because sometimes it's kind of hard to grasp how strong the compound interest force is. Picture a scenario where you are actually willing to invest $1,000 upfront and then also invest $100 on top of that monthly. What will happen to your money if you do that for 20 years? So take a look at this chart. We begin at year 0 where we invest $1,000 and then every month we keep adding $100 to it. This blue line is about our contributions here. But what is important to notice is the future value of our money. So as years go by and then we are reaching about year 20 or year 19 over here, eventually we get to have about $75,000. So notice that we began with just $1,000 and we kept adding $100 on top of it, meaning that every year we spent $1,200. And this is static, this is always the same, it's linear. But the actual rise of our gains is geometrical because of compound interest. It keeps doubling through the years. And this is extremely important for your investments in the future. And I want you to remember an important rule, the rule of 72 as we call it. It's an easy way to discover how many years it would take for our initial capital to double. And the way to remember this is picture that you have, let's just say $1,000, and you want to find out how long it would take for this money to double, become $2,000. And it's fairly easy to do so. Let's just say that you make 10% interest on your money annually. What you would do there is take 72 and divide it to the amount of interest that you are gaining. This is 10%, right? So 72 divided by 10 gives you 7.2. This means that it would take about 7.2 years for your $1,000 to become $2,000. This is a very neat little way to quickly know how long it would take for your money to double. And as you can understand, if you keep doing that, let's just say one more time, after 15 years now, your money would not have tripled, it would have actually quadrupled because of this geometrical rise that we talked about earlier. And this effectively tells you that the more time your money spends in the market, the more it gains on itself. Now let's move on to the second topic of this video. How do we make this 10% on our money? It doesn't sound too easy, does it? Now here's the kicker. Making 10% of your money annually is extremely simple as long as you invest in a strong economy. And this is the US economy in this case. A 10% annual gain over the years is virtually guaranteed if you invest in an S&P 500 index fund, which is basically tracking the US stock market. You may have heard about it 1,000 times. Everybody is suggesting invest in this thing called the index fund, the S&P 500 index fund. And it sounds a little bit complex, but what is it really? Now, the S&P 500 fund, an index fund, is basically tracking the 500 biggest, largest companies in the US in terms of their market capitalization. Because this fund represents a variety of companies and industries, it is a good way to represent the whole US economy and a good way to invest in the US economy as a whole. What's even better is that doing so is a good way to diversify risk. Because you are investing in 500 different companies, if one of these companies goes astray, let's just say they bankrupt, you have the other ones to compensate for it. What is also amazing about investing in the S&P 500 index fund is that it has been virtually making 10.5% annual gain if you take into account the last century. And even if you divide it into the last 20 years or 50 years or 30 years, it is always about 10.5%, as I'm going to illustrate in the video. And you may be thinking now, what about stock market crashes? These happen a lot, right? Yeah, they do happen, not a lot, but they do happen. And when they happen, they tend to last about 1.5 to 2 years for the most part. When they happen, the stock market typically sees a massive decline, which could be about 30, sometimes even 40%. But what is amazing about it is that after 1 or 2 years, it tends to come back with a vengeance. And so it is very typical that you see some years after that the stock market rises at about 20 or 30%. I want you to take a look at this awesome chart now, which is representing the history of bull markets, meaning good times versus bad times. Virtually every declining market period has lasted at most 1.5 to 2 years, followed by long periods of euphoria, as you'll see here in the markets. The market always bounced back after every recession and came back even stronger. As you can see in this S&P 500 chart, the market is basically always rising through large periods of time, as long as the US economy remains strong, of course, right? And it has been happening for the last century. The way you buy these index funds is you need to have a brokerage account. Now, typically, these brokerage accounts will ask for verification. They will ask for identification for yourself. They will ask, could ask for bank statements. They could potentially ask for a passport, if that applies for your case. Could also be asking for a proof of residence. And once you provide this paperwork to them, your account will be ready to go. And what you do from there is you actually wire some money to your newly created account. Depending on where you live, you're going to be having different brokerage firms. In the US, for instance, I have used Interactive Brokers. Robinhood is another one which I've used and it's super popular. E-Trade, Schwab, very, very popular brokerages. In terms of index funds, the most popular ones are Vanguard, which I definitely recommend, and Fidelity is another one that I would definitely recommend. And these last two tend to be very, very popular for pension programs called 401ks in the US. In terms of Europe, some popular brokerage firms are eToro. Interactive Brokers also operates in Europe. The Hero is another very popular one. And you can also find Vanguard and Fidelity, but I think they operate in specific countries in Europe, not everywhere. The third thing that we really want to talk about is how we go about buying our index funds now that we have our new account. And I want to illustrate with a video. I want to show you the full process through Vanguard, how you could go about finding the specific fund that we're talking about. In this case, it's going to be VOO, which is the S&P 500 index fund.
If we decided to invest with Vanguard, the thing we would need to do is visit investor.vanguard.com, open an account, and once this gets approved, send some money, do a wire transfer, send money to them, and then use the search page here and look for something like S&P 500. And you will see that the first result that comes up is the Vanguard S&P 500 ETF called VOO, and this is exactly what we want. Again, when we have money in our account, we just hit buy, and then we'll be able to buy the amount of shares we want to, meaning basically, let's just say 5,000 worth of shares. And this is how we go about it. It's fairly simple.
Now that you know how to buy the fund, it's quite useful to know what the composition of that fund is. Remember that the index fund consists of the 500 largest US companies, and they are weighted differently because, understandably so, Apple, for instance, is much larger than the 300th company in that fund. Notice, for instance, that Apple, being the top holding here, consists of about 7% of the total fund. This means that if you bought $1,000 worth of this index fund, 7% of this total amount, meaning $70, would be dedicated to Apple stock. Notice that the fund includes a lot of the top companies in the world, like Microsoft, Amazon, Meta, and Google, which you would potentially even want to buy as individual stocks. And that is because these companies represent a large piece of the overall United States economy. And the fact that this fund contains so many companies is effectively why we want to be buying it, because it eliminates or at least reduces our risk to a very, very low threshold. Because if one of these companies goes bad, yeah, we have all the other ones to compensate for it. Talking about the fourth part of our video, let's just say that you have invested in an index fund, but at some point you want to become a little bit more advanced and invest in individual companies. How do you go about this? Investing in single companies, I do that a lot personally, but you really need to understand the overall economics of a company. You do need to have a better understanding of how to evaluate a business. If you're interested in this, please leave a comment below the video. Tell me, would you like me to make a video in which I will be explaining in detail how to go about picking these companies? But for the purpose of this video, I'm still going to outline my personal rules about investing in individual companies. The most vital rule of all is that I always invest the money that I don't actively need, meaning money that I don't need for my personal daily expenses or money that I don't need because of extra debt that I have. I make sure that I pay my rent, I make sure that I pay my utilities. I also make sure that I have a reasonable amount of money in my savings account in case something happens. Typically, it is recommended to have 6 months of expenses in your savings account, but frankly, I would recommend to have even more because things happen in life. And when something happens, hopefully it won't, but if something happens, you don't want to be liquidated out of your stocks. You don't want to have to actually sell your stocks at a bad time because you need liquidity, because you need the money. What I like to say, the money that I invest in the stock market, I consider as if I never had it. I consider it as I've just burnt it, practically speaking, so that I don't have any access to it. Another vital rule that I always like to follow is I don't want to be going overboard with any single stock. Meaning that I want to allocate at most 5% of my total portfolio to any single stock. For example, if I have, let's just say, $10,000 for my total investment portfolio and I'm willing to buy Apple, this is going to be at most 5% of my total portfolio. And this effectively means that I'm going to be buying at most $500 worth of Apple, and then I will move on to another individual stock. Now, another important thing, do not follow hype. I know that there is potentially fear of missing out. You are looking at a company, let's just say GameStop, for example, which its stock kept rising every day and again rising and rising and rising for no actual reason. And you're thinking, I should be entering this one. But you have to remain restrained. This euphoria, while it can last for a long time, and yeah, if you enter early, you can make some money. When it dissipates, you can have a stock that really crashes to the ground, and you don't want to be taking any part in this. I won't get too much into the economics of companies, but I will tell you two things that are massively important. You need to remember this. Always be buying companies that generate, hopefully, massive amounts of cash flow. If a company is not making adequate amounts of money, what is it really worth to you? What is it worth to anybody? Does anybody know? It's all about the hype. You want to be making sure that you're buying companies that are able to make money and keep making money through the years. If a company makes tons of cash flow and something bad happens to it, there's some bad publicity, let's just say there is a huge lawsuit against the company, it doesn't really matter because through the years it's going to have a reversal, again because it keeps making money, and money is obviously the essence of any investment. However, it's not only about the money that the company makes, it's also about the money that they owe. So if a company has massive amounts of debt, I want to be avoiding it. Debt is actually the number one reason why companies go bankrupt. So you really want to avoid all these companies that have huge amounts of debt, especially if they cannot fulfill their obligations. You want to be avoiding those like the plague. As an extra, when I find these great companies, I want to wait on them. I want to get them at a cheap price. I don't want to be buying these companies when there's euphoria about them and everybody buys them at their highest levels. I want to wait for it a little bit. I want to have these companies drop. Sometimes you have bad news about companies that are doing well in terms of their financials, and they plummet. Their stock price actually plummets. This is when I want to be buying. Again, these companies that are making tons of money, have little debt, they keep doing well in terms of their operations. I want to be buying them when everybody hates them. This is my bread and butter. The stock market is very sensitive to bad news, but you should really welcome these price fluctuations and keep accumulating stock. The last rule is once you buy the stock, you forget about it, you do not touch it. The stock price could go up, it could go down. Just forget about it. Go about your daily life. Do not listen to the news, do not touch the stock, just let it grow, and in the years you are going to be getting a lot of money back. You really don't want to be scared out of your investment just because you heard something in the news and just sell in the wrong time when potentially the stock is about to boom. Hope this gave you a solid foundation about stock market investing. If you have any questions, please leave a comment below this video. I'd like to hear from you. And do let me know what kind of topics you'd like me to talk about in the next video. Thank you for watching this one. Remember to like and subscribe, that helps a ton. And I'll see you in the next one. Bye bye.